Welcome back to America's Commercial Real Estate Show. This segment is brought to you by Build Out. They are the commercial real estate broker's ultimate marketing tool. Visit buildout.com. Well, today we're talking about the finance, commercial real estate financing, the debt market. Let's see what is going on. Please welcome my next guest, Manus Clancy. He's Senior Managing Director with Trepp. He's joining us on the phone today. Manus, thanks for being with us.
My pleasure, Michael.
Well, Manus, there's been some talk about retail properties maybe and been a little state of flux. What's going on in the lending market related to retail properties?
Well, it's very interesting right now. The commercial real estate markets seem to move from one concern to another. And 2 years ago, it was the oil patch and what offices in Houston and Tulsa would be doing, and over time that migrated to suburban offices. And right now, that is in the retail space. And as you've seen from the headlines, over the last 6 months, Macy's announced it would be closing about 14% of its stores. JCPenney, 13% of its stores. Target had very weak earnings a couple weeks ago. We've seen smaller retailers like Gordman's and H.H. Gregg, along with Sports Authority, either flirt with or go into bankruptcy. And all of this has had an impact on those markets. And investors who have purchased bonds backed by commercial real estate loans or lenders looking at those properties are very concerned about the staying power of some of these traditional bricks and mortars retailers.
Yeah, and so what's that mean for retail property owners and investors in these properties?
Well, there's a couple of things. Number one is that your cost of borrowing will be higher than other traditional property types like an office or like perhaps a hotel that has had a long track record. Everybody will be looking at your property with a more jaundiced eye than ever before. And it probably isn't enough to have a strong rent roll in terms of duration. 5-year leases, 8-year leases, 10-year leases are great, but if your property is loaded in a older shopping mall, in a place where there's competition, in a secondary market, and there's exposure to a Macy's and a JCPenney and a Dillard's, you're going to get extra scrutiny regardless of how long those leases run.
Yeah, sounds like you might have 3 strikes against you there. Now, Manus, are some people banking on some of these loans defaulting that have a lot of retail in them?
That's very interesting. It's something that some of the major investment houses have been talking up as a trade, if you will. Some have gone as far as to call it the next big short, shorting retail properties, either shorting the REITs themselves, which have sold off in recent weeks, or shorting what is known as CMBX, which is an index of synthetic CMBS loans and bonds. And if you look at the vintages of 2012 and 2013, they're very heavily weighted with older shopping malls in secondary and tertiary markets, heavily weighted towards that JCPenney, Macy's, Sears, Dillard's grouping. And what the banks have said is there's a shorting opportunity to short those indices that have heavy exposure to those retailers. So you've seen a lot of volatility in that market with spreads really dancing around in that space.
Yeah, that's interesting. I think another thing that concerns the real estate market and the financing world is regulations. Dodd-Frank and the other regulatory changes. Does your industry expect that the regulations will be better for banking or worse, or what's the expectations there?
Well, it's interesting you should say that because while most of the headlines have been around Dodd-Frank, the one that really captures our attention has been this rule that's been in place for a long time. It's actually guidance. And the guidance is that banks should avoid having more than 300% of risk-based capital in commercial real estate loans. And in the past, banks have been able to treat that as guidance they've had a little bit more scrutiny if they've surpassed that threshold, but there wasn't really a great deal of scrutiny. Because what we've seen in the last 8 years is property values recovering to 2008 levels and beyond, the regulators have looked at these banks with high CRE concentrations and have asked them to tap the brakes even harder than ever before. What we're afraid of here, in some degree, and I'm not sure I'm ready to handicap this, is a liquidity issue where the CMBS market pulls back because of regulation that has kicked in 2017. The regulators are telling the banks themselves to tap the brakes because of increased scrutiny. And all of a sudden, borrowers in secondary and tertiary markets find it harder and harder to get a loan.
Yeah, that could be interesting, and it could be trouble for some and maybe opportunities for other. What about the impact of rising rates, Manus? What do you expect there?
Well, rising rates would be very concerning for us. Number one, the sins of, if you will, 2007 and 2008 have been forgiven in large part because of low interest rates. And by that I mean when borrowers were lending in the frothy years of 2007 and 2008, they did so when rates were much higher. So borrowers were getting coupons or interest rates in that 5 and 6% threshold. For the last couple of years, a lot of marginal properties have been able to refinance out of those loans into loans with a 6% handle, something like that, which made their debt service coverage ratio look tolerable to the lender. If you see a scenario where the 10-year Treasury goes back up to 3.5%, 4.5%, and borrowers are again looking at interest rates in the 6 and 7% range, that will make it much harder for these borrowers to get cash out financing on existing properties, existing loans.
Yeah, that's something to watch. Well, Manus, before you have to go, what tip would you leave with our listeners and viewers that own commercial real estate regarding financing today?
I would say a couple of things. I would say start early, for one thing. You may have a loan that's coming due in 3 months or 6 months or 12 months. You can't start early enough. You want to get ahead of what might be rising interest rates to really jump on that when you can, right? A 2.5% 10-year Treasury is not the worst thing in the world. Sure, you'd love 1.5% where we were a year ago, but 2.5% is not terrible. 4% would be terrible. And you just want to get ahead of what might otherwise be negative headlines in the market that make lenders more jittery, right? If there's more regulation that comes out by way of the regulators asking banks to pull back, or if you see more negative headlines with retailers, that would only push lending spreads higher. The sooner you can get your arms around this, the wider net you can cast, the better off you'll be in the long term.
And what would you recommend on amortization if someone was doing a loan today and they were a principal loan in the real estate? Would you say beware of 5 years, try to get 10, or does that even exist?
Well, the yield curve is so flat right now that you can get the same rate for 10 that you can get for 5. And if you can get 10, get 10.
That's right. All right, good tip. Manus, good information. Thanks for joining us today.
My pleasure.
And thank you for listening on the radio stations, on YouTube, on iTunes, and the show website. Feel free to comment on our show in our comment section below and share it on social media and tell us what you think about the state of commercial real estate financing. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.